Klarna became a household name when they teamed up with DoorDash, allowing you to pay off your DoorDash orders in installments of payments instead of upfront. And as silly as that is, it established the company with a mainstream appeal and made it really easy for people to use the service. The issue is that it actually may have been too easy, and that's becoming a problem for Klarna, both in the amount of people failing to make payments, the number of which is going up pretty significantly, and also the amount of money that Klarna is losing as a company, which has more than doubled from Q1 of 2024 to Q1 of 2025. And when you're a company that's trying to have an IPO and attract lots of investors, that's the wrong direction to be going. The Morning Brew talks about this and starts us off today. Buy now, pay later BNPL giant Klarna revealed that more customers are struggling with the pesky second part, which is the pay later. The Swedish fintech company, which allows shoppers to pay for their burritos and other items in installments, said this week that customer credit losses shot up to $136 million, 17% higher than in Q1 of 2024. The sign that buy now, pay later might be further burdening increasingly debt-saddled Americans comes as more folks rely on it. Now, it's worth noting that $136 million is actually not that much of the total amount that the company lends. But what we can ascertain from this is that it highlights a concerning trend that we're seeing across basically the entirety of the United States with consumers. Consumers are taking out more and more debt than they can actually afford to pay off. Debt levels, when not adjusted for inflation, are actually at all-time highs, and buy now, pay later offers one more new exciting ways for customers to get caught in debt cycles and to borrow money and then spend way more money than they had originally planned to spend on whatever item it is in interest payments, because that's how these companies make their money. And an inability to make the monthly payments is causing consumers to fall behind, and NBC talks about this. Industry-wide, buy now, pay later borrowers are increasingly falling behind on their loan payments. In a survey conducted by the credit platform LendingTree last month, 41% of users said they paid late within the last year, up from 34% last year. At least a quarter of buy now, pay later users took out loans to pay for groceries, the survey found, up from just 14% 1 year ago. And 41% is an insane number. Imagine like 41% of people falling behind on payments of basically anything else. Here are some other references that you can look at. The delinquency rate on credit card loans for all commercial banks is around about 3.1% basically. And during the height of the 2008 crisis, it was only 6.77%. Now, that is really high, don't get me wrong, but it's nowhere close to 41%. We can look at some other things here. This is the delinquency rate on single-family residential mortgages booked in domestic offices, all commercial banks. And you can see during the height of the 2008 crisis, when the delinquency rate hit its absolute peak, it was about 11.5%. Now we're sitting around about 1.8%, but that's still 1/4 of the amount of people that are falling behind on these buy now, pay later loans. One more I want to reference here is Americans are behind on car payments at a record level, and that record level is still just about 6.6%. If we add in prime and subprime together, that's about 7%, which is still like, what is that, 1/6 of the buy now, pay later delinquency rate. You can see that this is kind of a big problem that it seems like very few people are talking about. Now, I want to be clear, it is not one-to-one. There's different demographics, the sample sizes might not be representative of the whole country, and honestly, it's kind of not surprising that this number is so high at 41%. Companies like this specifically target/prey on people who have lower incomes. Think about someone who has to use buy now, pay later. Probably it's someone who can't afford whatever thing it is outright, which means they have to use the service. But why would they use this service over just their credit card? Well, probably their credit card is maxed out, or maybe they have such bad credit that they're not eligible for a credit card, or maybe they can't afford to add it to their credit card payments because the credit card payments are already so high at like 25 to 30% variable APR. It's disproportionately these low-income people that have no other options and nowhere else to turn to that are signing up for these buy now, pay later services. These services are essentially just taking advantage of desperation and hoping to make a buck down the line before you go bankrupt. Low-income people are the most likely to sign up for this service because, like I said, they have no other options, and they're also the most likely to fall behind on payments because they're the least likely to have the money to actually be able to pay off the loans. And what does Klarna say about all of this? Well, they pretty openly don't care. A Klarna spokesperson said that 17% jump in consumer credit losses, quote, doesn't tell you much about the U.S. consumers, and pointed instead to the company's credit losses as a share of the total sum that it loaned out, or, quote, gross merchandise value. And it's kind of interesting to position debt and taking advantage of people with low incomes who can't afford to make payments as merchandise value, but that's neither here nor there. This metric rose from 0.51% to 0.54%, the spokesperson said, quote, so a very slight increase, but still very low. But I would argue that the spokesperson is wrong. Here they say that it doesn't tell you much about the US consumer, but I think that it actually does, especially when you consider that consumer sentiment is basically reaching all-time lows, and debt, when you adjust it for inflation, has still been climbing, which means the amount of debt being taken on by Americans is outpacing the rate at which inflation is growing. And I would say that that should tell you a lot about the American consumer and that they're struggling right now. And Klarna is just really another company trying to take advantage of that. Before we move on, if you enjoy this kind of deep dives into the news, I post videos 1 to 2 times per week, and I'd love a subscription. Now, on the investor and purely business side with no regard for humans or anything like that, it's reasonable to say that sure, the defaults are going up, but as long as the company as a whole remains profitable and increases their profits every year, then it's not really an issue, right? I mean, after all, credit card companies have tons of delinquencies all the time, and they function just fine, earning billions and billions of dollars every year. Well, you remember earlier that I said that the company's net losses doubled. And actually, I was under-exaggerating. The Swedish payment startup said that its net loss for the first 3 months of 2025 totaled $99 million, significantly worse than the $47 million in losses that it reported a year ago. Klarna said that this was due to several one-off costs related to depreciation, share-based marketing, and restructuring. The first thing I have to say is that with 110% increases in company losses, I struggle to believe that the explanation that they've provided is actually correct, because things like depreciation and share-based payments and restructuring, you would have had all of those in 2024 as well as 2025. Even if they were a bit more expensive this year, they're certainly not more expensive to the tune of 2.1 times increase in net losses. But then right after that, Klarna goes on to desperately try and bury the bad news by saying this: revenues at the firm increased 13% year over year to $701 million. Klarna said it now has 100 million active users and 724,000 merchant partners globally. And this is only technically correct because the revenues did go up by the 13% that they said, but that doesn't at all tell the whole story. Here we have the financials and key metrics that Klarna released, and I think they released this because they're legally required. Most Nordic countries, public or private, are required to release all of their statements. Right here is where we have the total revenue increase. Q1 2024, 621 million. Q1 2025, 701 million for that 13% increase that they talked about. But then we have to look right below that, just one line down, and we see processes and servicing costs, which increased by 25%. Then we see consumer credit losses, which is what we talked about previously with people being unable to pay back. That increased by 17%. Then we see funding costs. That increased by 15%, with the total transactional costs increasing by 19% and the transactional margin dollars increasing by 4%. They're really bearing the lead in these public PR-facing statements that they're making because sure, the revenue increased by 13%, but then almost every other expense on here, except for one, increased by more than that 13%. Klarna basically only continues to function because investors continue to pump money into it, thinking that one day it will be able to take advantage of enough low-income people that they'll be able to turn a profit. But just having investors pump money into a company isn't going to make it successful long-term. You need paying customers, and therein lies the issue. Look how DoorDash announced that it was going to be integrating with Klarna. This is the pitch they were making to everybody so that they could use it. DoorDash partners with Klarna to offer US customers even more convenience with flexible payments. New partnerships gives customers more ways to pay for groceries, retail, meals, and more. And there's just one tiny itty bitty little problem with that. It's not true. It's not even remotely true. Not even close to true. There's only one way to pay for this groceries, retail, meals, and more. And that is with money. There are not more ways to pay. There are just more ways to defer payments until you can't anymore. And then there are many ways that Klarna can make money off of you having to make interest payments on the amounts that you defer. Klarna is literally hoping that you will fall behind on the payments, make lots of interest payments for as long as the company is around, make them tons of money. I mean, that's how the company is set up. That's their value prop to investors. So please do not use this service. The company is literally preying on people who feel like they are out of options. Thanks for watching.